So my name is Jason Casey. I'm from Common Fund. I'm an assistant director there on quantitative research and also do alternative investments. Should be a little bit higher.
Moving closer.
Okay.
Yeah.
So, hello, can you hear me now?
Yeah, we're good.
Excellent. At Common Fund, I do work in quantitative research, looking at how portfolios should be put together, thinking about how the organization of what assets should be doing in terms of how we're placing them, what's the allocation, what is the selection of our managers. We do this for not only our alternative funds, we do this for our equity and fixed income funds as well, and less for our real estate funds, and less for our privates. However, we do look about where the market is and how the strategy should interplay with each other. And my expertise, while I joined Common Fund, I did a lot of commodity trading at Common Fund. We had a direct fund which we managed, and I was part of that team. And I'm here to speak on that knowledge that I have from a portfolio manager's perspective.
Next, we have Andy Weissman from Wyndham.
Hi, I'm Andy Weissman from Wyndham. My background, I'm a guy who stayed in school probably too long and won some research prizes that my mom's real proud of. And on the editorial advisory board of the Journal of Portfolio Management, the board of the Institute for Quantitative Research, and the Q Group, and the IAQF, and so a bunch of stuff like that. But I actually do research on commodity investing and also risk premium investing, and I'm the chief investment strategist. I think that's my title at Wyndham. Thanks.
I'm Paul Luchek from Ratio Advisors. I'm the CEO and co-CIO of the firm. Ratio is a successor company from Saris, which stood for State Street Absolute Return Investment Strategies, long name. Began there in 2004. Met Mark Rosenberg, who founded RXR, which became Saris, somewhere around 1997, and ended up working with him in 2004. Mark began his investment career on the floor of the NYMEX in 1968. So we've been trading commodities back to 1983 as RXR, back to 2001 as Saris, and we launched Ridgedale in 2017. So we're a trader of commodities. We mix that into our absolute return programs. We have absolute return programs that trade commodities plus stock indices, plus currencies, plus fixed income, but we also have commodity-specific programs and managed accounts, and we're lucky enough this year to be launching a commodity-specific fund, Commodity Alpha Fund. Tonight we have a very interesting discussion on commodities. It's very relevant to the time right now. If you've been looking at any of the reports on Bloomberg or CNBC, commodity markets are really something that is moving at this point in time in this year. And the panels, our panel is, we've had some very good discussions already as we're preparing for this panel, and we hope that you enjoyed the discussion we have tonight. We're going to save questions till the end. The last 10 or 15 minutes we could have questions from everybody here. And one thing that we decided to do at the very beginning was, because commodities are a different type of investment, just to go into some of the sort of the basic introduction to what commodities are and how they're different from other asset classes, and some of the vocabulary that is specific to commodities, so that when we start throwing around terms like backwardation, contango, convenience yield, you can understand what we're talking about. So Andy's going to bring you through a couple of slides about that to begin with.
All right, I think I'm going to stand up. That way I can point at things. Can everyone hear me okay?
Yeah.
All right, good. Okay, this is sort of a Jolly Rancher style color scheme that I put together the other day. There is a lot of vocabulary that is kind of specific to commodities. And as Paul pointed out, we thought we'd share that some with you so that it doesn't feel as though we're just simply talking to each other. And the first thing is, a lot of commodity investing gets done through the futures markets. And that's very important. It doesn't always have to be that way. There are all sorts of other interesting ways to skin this cat. You can actually buy storage facilities, and you can do other things that require significant amount of capital. But the bulk of what goes on for professional investors, hedgers,
specs is done through the futures market. So what is a futures contract? And that's kind of important to think about. First of all, it's a standardized legal agreement. It's traded on a futures exchange, so when you trade, your counterparty is not the guy who bought the futures contract effectively from you. Your counterparty is the exchange, and that takes out a lot of the counterparty risk. You're going to buy a particular commodity or financial asset at a predetermined price, which is established at the point you transact, and it's for a specific specified time. So these futures contracts are highly standardized in terms of dates that they expire on. Here's an example of one. Some of the specs associated with crude oil, 1,000 barrels, priced in US dollars. Most commodities are actually priced in US dollar terms. Except, things like sometimes there's Azuki bean contracts traded in Tokyo that might be done a little different.
London cocoa.
And
Yeah.
London cocoa, yes. So the minimum price fluctuation is essentially a cent, which is worth $10 on a single contract. The delivery point, if you're crazy enough to hold on to that futures contract and put yourself in a position where you take delivery, it's going to show up in Cushing, Oklahoma through a pipeline. And there's a specific grade that qualifies in this case. It has to be this light sweet crude. And lightness refers to kind of the color and fluid viscosity, and the sweetness is low sulfur content, basically. And so, that's an example of a contract. Now, the next thing that we're going to talk about is this futures term structure. And that, like I said here, is a curve that plots the prices of futures contracts against their expiration dates. So we have spot, and then we have a contract that might expire in March, and that'll have a price. And then another contract that expires in June, and that'll have a price, and if you drew a line through that, that's called, the futures term structure. And that term structure has a lot of information. You have all sorts of information about supply and demand and people's expectations, and even gives you a lot of information about what direction prices are apt to go. And just to level set just how intelligent these markets are, there was a very interesting paper done by a guy named Dick Roll, who, famous economist, is actually a Caltech trained rocket scientist. He compared the ability for the closing trading action in the orange juice futures markets to predict the overnight low temperature in and around Orlando, Florida, versus what was being produced by NOAA using a satellite, which cost them about $100 million. That was in geosynchronous orbit above Orlando, because that's where a lot of the orange juice is produced. Turns out the futures market's better at predicting the overnight low. So these are really smart markets. Direction. Okay, couple of terms. Backwardation and contango. Okay, so backwardation just means that the term structure is downward sloping. A backwardated market is a market where a futures contract that expires well out into the future is going to be cheaper than the contract that's at the front end of the curve or the spot market. Similarly, a contango market, the back end of the curve, is essentially more expensive than the front contracts. You need at least two contracts to determine if the market's contangoed, so therefore you need two to contango. Generally speaking, and we'll explain this in a few minutes, the market is equally backwardated. That means there's a lot of premium, that's a very cheap market, there's a lot of money being transferred from hedgers who are hedging at the back end of the curve. This would be typically producers of commodities, and a premium that's being provided to you at the front end of the curve by people who are hedging to buy things to make sure that they have security with respect to the delivery of the commodities that they need. So this generally indicates a market that's in tight supply. This means typically a market that's well supplied. Just something to keep in mind. We're going to say backwardated, we'll say contango. Stop down here. There are a couple theories that are kind of important to thinking about commodity investing in general. There's a convenience yield. Think of this as a premium that is given by consumers of commodities to speculators. So these would be people that give me money and all money and Jason as well, in order to ensure that they get delivery, that they essentially have a secure supply. So they want to make sure that they have that commodity as they need it. So if you operated a very large bakery, Wonder Bread, for example, you want to pay up to make sure you have that wheat available to you. And to the extent that the curve is backwardated, that indicates that they're really giving you money significantly to speculators, so that they'll essentially short the front end of the curve. That's known as convenience yield. This is something that is provided to the back end of the curve by producers of commodities typically. It is a theory originally proposed by John Maynard Keynes called the theory of normal backwardation. It just represents a premium that is provided by, well, we can continue with wheat. If I know that I have a crop coming due in September, and I know that the price is a price that I can profitably produce my wheat in, I'm going to forward sell it and be certain that I can survive as a business, a farm. So that's called the theory of normal backwardation. So those are a couple of little theories that can help you think about how investors might think about investing in commodity markets. This is the last thing we're going to look at. So, I was told there would be no math on this, but we're going to do just a little bit. So we have an equation here. And this equation has something in it up here that is an important insight into commodity investing. It makes use of the letter E, and that is, of course, Euler's number, very important number. And it was, of course, developed by none other than Jacob Bernoulli, not Euler. It's a little trick question. And it's used for describing growth rates. You take something today, and it grows at 5%, that's E raised to the 0.05, it will grow at 5% compounded rate a year. And so this is the equation that specifies the term structure in the futures market. It has a few variables in it. To the extent that interest rates are high, to the extent that storage and insurance costs are high, you're going to get a contango curve. Things will grow. To the extent that there's a lot of premium and a lot of fear built into the market, you subtract that from it, and then you multiply that by time. So you can use that equation for doing all the static dynamics in your mind to consider how an investor in commodities would think about this.
And I just want to add something to make it a little more familiar to everybody in the room. I think we've all seen the S&P 500 and the fair value price on the morning, when it says where it is. Well, that fair value price is determined by this equation, except with the S&P 500, it's just using interest rates and dividend yields to figure out what the fair value of the S&P 500 should be relative to the S&P 500 futures. So this is the same thing, except now we add an additional term, storage cost,
right,
and convenience yield.
Right. So there's a convenience yield. You could also throw in the backwardation effect that Keynes thought of. So in other words, you're going to have a curve that slopes up if interest rates are very high, storage costs and insurance costs are very high. You're going to have a negatively sloped curve if people are really paying up and providing you as a premium and cheapening the market for you if they're concerned about their ability to sell commodities or buy commodities. So this is, this is the cost of carry model. It is a way that investors tend to think about investing in commodities. And so, to summarize, at the beginning, real quick, we know what a futures contract is, we know what the term structure is, we know what backwardation and contango are. Convenience yield, that's something that's essentially a premium that's given by hedgers at the front end of the curve to ensure supplies. This a theory of normal backwardation is another form of premium that's given to investors to ensure that they can produce profitably and sell their commodities at a future date. And this is the equation that governs all those relationships. I hope that helps. Now we will proceed.
So the first topic that we're going to go into is basically portfolio allocation to commodities. Why would you want to do it, and what benefits does it have? And Jason's going to cover that.
Hello again. All right. So if you think about what a normal portfolio, or not even a normal portfolio, if you think about your 730 portfolio as allocated, you have stocks, you have bonds in it, or you might have some fixed income assets or in there as well as a diversifier, right? You have your main risk portfolio, which is your equity portfolio, and that is normally determinative of how well your performance is with with the bond portfolio, sort of counterbalance that, and add some defense in case things go wrong. Now that blend of 70-30 has worked really well and is a great indicator of what a general portfolio should in theory look like if you're going really passive. However, the thing about commodities that are different from bonds and equity is that they're kind of lowly correlated, if not negatively correlated. And because of the correlation properties of commodity markets and commodities in general, they play a significant diversifier for your equity portfolio. You notice over time when equities are low performing, commodities will be up. And that's due to some of the stresses that happen in a system which sort of like peaking inflation, maybe a war, things that bring attention to make people feel very conscientious about their equity portfolio are the kind of things that drive commodities to spike and to raise and get really good performance. And so as a diversifier in your portfolio, it has a really nice balance and counterbalance to your allocation in the portfolio. Now, the thing about commodities in terms of the volatility and in terms of the return perspective, they're around the same in terms of riskiness is about the same as the equity portfolio. And in terms of return, it's about the same as your bond portfolio, with a negative correlation, allowing it to sort of self-balance itself. So when we add it to a portfolio, over time, it should just outperform that 70-30. And it has until 2007, where we're going to get there. Oh, we're there already. Okay, didn't notice that the chart was up. So if you can see here, over time, this portfolio of 70-30 versus the 55-30 and 15 in commodities has overperformed until 2007. And everybody here, I hope, was alive during 2007. It's okay if you weren't. But during 2007, we had a significant event called the Great Financial Crisis. And during the Great Financial Crisis, there were things done to the bond market, to the equity market, to sort of stabilize things and sort of build in these conditions of stability, which made commodities suck. Those be the facts. So there was a lot of financial controls and a lot of inflation put into the system, a lot tampered inflation, sort of risk controls. There was a lot of gold selling. There was a lot of things that sort of traditionally you meant to sort of keep the market very calm and very stable, and not allowing expansion to happen. A lot of sort of, and by expansion, not physical asset expansion, financial, and not allowance of physical asset expansion, a lot of financial asset expansion, which happened in the equity market. So we haven't seen that breakdown happen until the stopping of that breakdown happened until we got to COVID, where you start to see supply chains sort of freeze up because there was no delivery being taken. Everybody was closed off. Nobody wanted to sort of deal with what's happening in terms of physical delivery until you had the event of when oil went negative and then delivery became super important. People started to say, hey, oil is going to be worth something in the future. It shouldn't have a negative price. Maybe we should start investing. And at that point, that was the bottom of the commodity market at that point. And from ever since there, we had inflation because we had supply blockages and we had supply chain disruptions, and we've had other things that sort of helped commodity prices place themselves better into the portfolio. And we also had the delinking of globalization, which is the other primary factor of why things have worked out well since 2007. Increased globalization got to the point where all markets got to the point where commodities were really depressed and under control. When globalization has gone away, people are start housing things internally. They no longer trust that Japan was able to deliver on what they could do. They no longer trust that China is able to deliver the lowest cost of commodities. Everybody wants to bring things in-house. and there's a will to bring things in-house. That raises the price, the bottom price for what a commodity costs. And so from now going forward, with the globalization happening, you have increasing commodity prices, and you will have increasing commodity prices. You have increased volatility in commodity prices because there's unsurety about who's going to be the lowest cost provider, and you may want to have that low cost provider might not be someone you're friends with. So you may want to internally house some of these things. Because of these events, you're going to have increased inflation. And because you have increased inflation, which is representative of commodities are going to make sense going forward. I'm going to yield and let anyone else speak to it.
So I just want to add two things. One to Andy's idea of the convenience yield. One way to think of it was the way that Andy described it. I think another way to think of it, or perhaps a simpler description, is to say that the futures price relative to spot. So the futures price relative to what you'd actually pay in a physical market for a commodity is equal to spot plus what the interest rate would cost to hold that commodity plus the storage cost. Okay? So if your convenience yield is greater than your interest rate and storage cost, the commodity is going to be in backwardation. And the idea that some people think of convenience yield think that the convenience yield can be described as is an option. Because if I'm a producer and I have crude oil, I have an option to store that crude oil in a tanker and wait a month, wait a year, wait 2 years even, okay? I have this oil, I can bring it to market whenever I want to. I don't have to deliver it now. I also have the option of delivering it right now. So the convenience yield I have is the value of the premium of that option. If it's greater than the interest rate and the storage cost, then the market's in backwardation, and I might as well bring it to market because I'm going to get a good price for it. If it's March of 2020, when crude oil went to negative $30 a barrel, you could actually just hold it for longer if you could find means to store it. And that's why it went to negative 30 a barrel back then, because there was no Cushing. It was full out, and there's just no place to store it. So that's just another way to think of convenience yield.
And there were financial products that had been created that actually required people to sell that particular contract. So not the entire curve, but just the part that folks had to actually roll out of.
So with that in mind, I wanted to throw forth a question that we were discussing earlier, and that's regarding the business cycle. And the question is sort of where are we in the cycle, mid-cycle, pause, late cycle? And classically, commodities tend to rally in late cycle. Although we had a little bit of disagreement on it, and I think it's an interesting discussion. I'll throw it to Jason.
So classically, if you look at the studies and you look at sort of the performances, that late cycle performance is true, right? Just the way that the sort of return perspective worked out. But in theory, it should be a little bit different. In theory, what you have is during a recession, after a recession, you're going to have particular things that are sensitive to that cost of carry, to your convenience yield, right? So what happens is you have inflated interest rates, right? You're going to have inflated interest rates because there are things that are going to be very uncomfortable at the end of your business cycle, right? Things are getting hot. The Fed is looking at the market. Most federal banks are looking at the markets and they're saying things are very hot. We want to taper. We want to calm that down. What they do, they raise interest rates. That puts pressures on your capital structure. Commodities are very capital intensive, and that in itself lends itself to be like, okay, because of the capital intensity and because of the interest rates, you no longer can support developing, going out and exploring more oil wells. You can no longer have that. We can no longer store things in storage with the expectation to hopefully hold it long enough that we could get past a certain period, because storage is expensive in terms of interest rates. Those things lead to the decline in production, right? They also lead to the decline in prices, because capital intensity is, during that same period of time, you're having other things that are happening in the market which allow commodities to become too expensive. And so they're going to be glut in terms of inventory space. There are going to be other things that are happening in terms of like, no one wants to buy at this point in terms of development because they fear a recession is coming around. So they're like, why would I buy, more sneakers at this point? I feel as though this might be a bad time to buy because in the future, we're running a little hot in the economy. So why would I buy sneakers? I can wait, right? Wait for the depression to happen and buy then. So
that late cycle performance is an anomaly because of the theory of it is that during that late cycle, commodities should be under the most pressure, right? And during the recession, right at the bottom of the recession, that's when commodities should rise because you have very low yields, you have very low interest rates, you have very low inventory because people have used all their inventory out, and then you have the convenience feel of having those two things happen coordinated together. So production is low, has just started to be low. Inventories are low, and interest rates are low. So you have the starting of production, you have the starting of building out your inventories, and you have the starting of people getting back to figuring out what's going to be working for the next rise, for the next expansionary period. So from the bottom of that recession, in theory, to the start of the next expansion should be when commodities work the best. Evidence has proven otherwise.
Yeah, I would. Oh, here we go.
So the business cycle is kind of an interesting thing. It's a theoretical framework, and there have been lots of different theoretical frameworks surrounding lots of different topics over the years. There was a notion of something called phlogiston. I don't know if you recall that. It was essentially this mythical substance that allowed for the spontaneous generation of life, and they proved that it existed by taking boxes and putting meat in it, and then larvae would appear in the meat, and so that was proof that it. So I'm not sure that the business cycle, in a certain sense, is a real thing. It's a human construct. It's a set of theories and ideas. I actually think at the moment we have a very unique situation, that doesn't fall neatly into the concept of what we typically would describe as a business cycle. We're coming off a global pandemic, and that has really some profound impacts, which I think even at this point we've repressed. We went to 30% unemployment briefly. We have racked up vast amounts of debt, and we've created a situation for ourselves right now, which I think is really probably the most useful way of thinking of things theoretically at the moment. It's a unique situation. So there is something that the Federal Reserve right now is dealing with, which is understanding what R star is. I don't know if you know what R star is, but it's this mythical interest rate, real interest rate, that is consistent with both them meeting their inflation targets and having full employment. There's the new thing that came out at the end of 2023, a couple of economists at the St. Louis Fed, they came up with R star star. So it's got an extra star. It's kind of the spinal tap of R statistics. The volume goes up to 11. This one has an extra star. And it is that mythical interest rate, real interest rate, up through which you push interest rates, that you start breaking a lot of China and blowing up the economy, okay? And their idea was that we have been in such an accommodative environment for such a long period of time that it may well be the case that R star is a higher number than R star star. In other words, we may have to blow this thing up in order to get back to where we want to be in terms of our inflation and employment objectives. And that seems to me to be the thing that is scaring people at the moment, and why you are seeing people, for example, in the gold market, it appears to be a combination of things, which is significant central bank buying by rogue nations. So, in Q4 alone last year, Russia increased their inventories of gold by 26%. Switzerland, which I'll throw into that category there, that went up by 7%. But it seems, so that's part of it. But the other part is the market effectively pricing in the possibility of an error, of a mistake, of a set of policy decisions that, where the Fed just simply is failing to recognize what it is they need to do and prolonging things. And so we're starting to see the back end of the yield curve kind of pick up a little bit. We're starting to see the stock market accelerate, and we're starting to see movements in metals markets that are indicating that this economy is still feeding off of a great deal of fiscal and monetary stimulus. And we can't forget at the moment that, yes, the you know, the pandemic is over. We're paying for 2 wars at the moment, you know, and the Fed, despite the fact that they're bringing down their system open market account, which is their portfolio, they're doing it by allowing things to roll off the book at a slower rate. They're still buying a lot of fixed income. They're still injecting a lot of liquidity. So there's a real story here that maybe it's not the business cycle so much at the moment that I should be concerned about the possibilities of you know, policy errors, a very strong inflationary impulse. And commodities provide you with you know, a very important you know, source of return that Jason pointed out, and Paul will talk about as well, which is if you have part of your commodity investment not a simple long-only ownership of the asset class, but rather something that creates a straddle-like payout in movements in that market, right? Effectively, an insurance policy that moves up too much or moves down too much, you get paid. Those sorts of investment techniques applied to the commodity markets are particularly useful because you end up with a call when bad shit happening in the world, and those payouts, which tend to be can be very profound, very significant, are a great portfolio diversifier because their peak periods of performance tend to occur when exogenous events are happening that destabilize the rest of your portfolio.
I'm fortunate enough to go third in this answer to this question because it's a difficult question. And I asked it without actually knowing where we are in the business cycle because, as Andy points out, with COVID perturbing this, it's not 100% clear. But I will just relate that after 2008, commodities dropped along with other asset prices. They recovered in 2009, 2010. But in that period from 2010 to 2019 of quantitative easing, where central banks stepped in over and over and over again to really remove volatility from the market, commodities hit a doldrum. And I think that's why a lot of investors lost interest. They just weren't excited. But coming out of the pandemic, something happened, and that reignited commodities and reignited the interest in commodities and the need for physical commodity supply. You know, there were supply shocks. We went through weather events. We went through droughts. We went through floods. We went through, right now, the Panama Canal has not enough water to enable full shipping. Add that to additional shipping concerns around the Red Sea, such that in 21, commodities were up 27% when we talk about the index. In 22, they were up 16%. This is when both stocks and bonds were down. Last year, they reversed and they were negative only slightly. And I think it's largely because of policy decisions where when things became too expensive and people were worrying about inflation, a lot of policies were relaxed about deforestation, able to collect commodities, drilling. When that policy was relaxed, commodity prices came back. This year, just look at the commodity index, it's up 6%. But looking at some individual commodities, crude oil up 16, gold up 15, coffee up 20, aluminum up 30, copper up 12, and there's a special case which we're going to discuss, cocoa, which is up 147%. So I think we're back into a cycle where commodities are of extreme interest, and they're going to stay that way until or unless we hit some type of recession. In terms of how to invest in commodities, you know, there are active strategies, there are passive indices. I'm just going to describe a couple of the indices in terms of the way to invest in them, and then we're going to talk more about what is the source of risk premium commodities and what's the source of potential investment returns. So in terms of the indices, the first one was the Dow Jones Index in 1933. After that, the Commodity Research Bureau, CRB, created one in 1958. None of these were very practical because they just weren't investable. So the first real investable index was put forth by Goldman Sachs in 1991, GSCI. It was backfilled to 1969 and became investable in July of 1992. It's production weighted with an eye to limiting it to contracts that have liquidity, but its primary construction is production weight. And as a result, approximately 70% of it is energy products. So it's not a very diversified index. In 1988, Dow Jones AIG came into play, and they decided to try to work with the same concepts, but correct some of what they saw as shortfalls in the GSCI. Those were, it's not diversified enough. So they created an index in 1998, backfilled it to 1991, became investable in July of 1998. So not only is it production weighted and liquidity weighted, so they combine both how much is traded of the commodity and its worldwide production, but then they put limits on it. No commodity can be more than 15% of the index. No related commodity, for example, Brent plus WTI, two oil contracts, can't be more than 25%. And this is more important, no sector can be more than 33%. So the energy sector has been basically pegged at 33%, but it's only 1/3 of your index. So you have other sectors, you have agricultural commodities in there, you have metals in there, precious metals, you have industrial metals, and they're all contributing more than they do to this. And as a result, I think that index has become sort of the go-to index that people talk about, that a lot of firms invest with. Maybe Jason can talk about that in terms of what benchmark to use. I think it's largely become the Dow Jones AIG, transferred to UBS, that was in 2009. And then it became the Bloomberg Commodity Index in 2014. So we call it BCOM, Bloomberg Commodity Index. So I think that's really the main index now. So that's the passive way of investing in a commodity product. The active ways are with active managers, as the three of us are. So we definitely have a bias towards active management. When I turn to Jason.
So, in terms of getting exposure to just commodities, this is made with Pecan, by the way. This is Pecan strategy all the way. And you can see that, Dow Jones UBS, Dow Jones AIG, Dow Jones UBS to Pecan, which it is right now. As you can see, it had great performance until 2007. And in terms of like passive exposure to commodities, the beautiful thing about commodities, the subsectors, and even the individuals in those subsectors, they don't correspond well to each other, meaning that they have typically a very low correlation amongst themselves. For instance, grain contracts behave very differently from livestock contracts. One is an input for the other, but they are not necessarily dependent, they don't necessarily trade together, right? Corn is used as input for like cattle or for lean hogs. Lean hogs have nothing to do with metals, nowhere. Like there's nothing that you can take lean hogs and say, hey, copper contract, what's the connection between the two? There isn't, right? Copper contract has nothing to do with gold contract. Silver contracts, nothing to do with use. Silver contracts have very low correlation to oil contract, to a Brent contract, to a natural gas contract. Natural gas is its own child, which we'll see in the chart. But all of those sectors have very independent themes, have very independent stories going on with each other. So they're very diversified. So moving from something from like a GSI-backed index, which is 70% energy focused, which has a very high correlation amongst each other, to something a little bit more spread out, like the Dow Jones, like the BCOM index, you're getting a lot more flavor, you're getting a lot more diversification in that long structure. However, in of itself, that also is a less superior strategy, right? You may want active management to be able to play those different sectors off of each other. So for instance, you might feel as though, well, my corn input is a little bit low. I know that's going to impact lean hogs at some point. I know that's going to put a lot of pressure on cattle. I know that's going to put a lot of pressure on other forms of livestock. I may want to play one off the other. I might have a theme that it makes sense to take the spread of the two. Or you might feel as though delivery in terms of the calendar spread might be a little bit more concentrated because you're looking at your backwardation, you're looking at your contango markets. You can say, oh, supply is very tight here, and it's going to be very, very loose in the end. So you might say, oh, I may want to play the curve structure of the contract. And so where active management can give you some benefits is because you have intelligent people or intelligent things looking at these strategies, playing these themes off of each other, making either localized or generalized solution sets for these particular strategies and putting them into play and adding that, an alpha to your beta of a commodity. So that's kind of why active strategy makes a lot more sense. However, long only has worked over time, but that alpha you get from a really active manager makes this picture look very differently.
I would say, oh yeah, Just. Okay, one of the, I believe, one of the worst ways you can invest in commodities is a passive long investment through an index at the front end of the curve. Because effectively what you're going to be doing is paying away the richest anomaly and giving up all of the premium that's built into the prices of commodities as a function of the term structure, as a function of fears in the market and hedging requirements. So that's one of the richest anomalies that I was mentioning is this roll yield effect, where you can buy the back end of a heavily backwardated curve, and you're likely to end up with a future spot price that is higher than is indicated by the back end of the curve. And so that's an issue for me. And where you pay a professional to do this for you is to have someone who is constantly looking for points anywhere along the term structure of any of these commodities that are particularly rich or cheap, and being prepared to invest at those points, either selling or buying. And so there are really three things that we would focus on. One of them is this roll yield. There are ways you want to do it, and there are ways you don't want to do it. And primarily the things you don't want to do. And I think I've said this before, I have very little good advice to give people. And it's mostly things like never play cards with a guy whose last name is a city, like Chicago or Pittsburgh, because they're going to take your money. Don't date anyone with a tattoo of a dagger on their arm. But the other thing, as it relates to commodities, is you just don't short the front end of the natural gas curve, because that is the widowmaker of all trades. Because these commodities, and this is really at the heart of what it is you need to know about this asset class, is that you're dealing with an asset where there's essentially an inelastic demand and an inelastic supply. And every once in a while, the supply simply goes away. And if there's a war, a drought, a frost, and the supply of energy is limited, and the supply of food is limited, people like Jason will still selfishly insist on feeding himself and warming his home, and the market essentially clears whatever it's going to clear, and you end up with this huge amount of what you would call the fourth centered moment of a distribution, called kurtosis. Yeah, and this is actually a slide I put together just to show how absurd it gets in the setting of the commodity markets. So what this thing represents is, imagine if you took the weekly price changes in commodities and just assumed they were normally distributed, which you should not. We'll do it for the purposes of creating this. And you say, okay, I observed an event that was 6 sigma, 6 standard deviations during a particular week. And when's the last time, based on that event, that I should have seen something like that? Okay, so I'm a 6 sigma event on a weekly basis. What are the probabilities associated with that? Well, we have a number of commodities here. I think one of these was natural gas. This is gasoline.
That's nat gas.
Yeah, this is nat gas. Okay, so this move, the last time you should have seen this one under normality, under the assumption of normality, is approximately 12 trillion years before the universe began. This one is 50 trillion years before the universe began. The move in nat gas that blew up Amaranth, I believe, is this one. And we had, Homo erectus was leaving Africa. And that actually explains to me a lot about what happened over at Amaranth, quite honestly. But it was shorting the front end of the natural gas curve. So you're dealing with something that is highly right-tail skewed, which is a very unique aspect of this. And it can result, if you have a portion of what it is you're asking your investment manager to do, to capture that effect and to benefit when there are these exogenous shocks that destabilize typically the rest of your portfolio.
To bring that into, excuse me, into dollar terms, we've done a study on the daily dollar volatility of commodities, and this is the average daily dollar volatility of commodities have experienced. And as you see, there was a large spike in 2008. And what people don't realize, because most people, when they think about volatility in the current environment, they think about equities. And equity volatility has not been high, in the recent 2 or 3 years. What they don't realize is that volatility in other markets has actually approached, and hasn't exceeded yet, but has approached, the volatility experienced in 2008, which was, as Andy would say, that probably shouldn't have happened, for a trillion years, that type of volatility. So really, in 2022, the war in Ukraine added to commodity volatility. Everything from oil to wheat to grains to basically everything. And that volatility approached being as high as it was in 08. The other part of the study that we did, and this is where it helps out equity markets specifically, is that when these crisis events hit, 3 things happen. You almost define a crisis event by what is the increase in volatility. So in the risk book series, Commodity Investing and Trading, I have a chapter with Mark Hooker from State Street, and we looked at year over year, 2007 versus 2008 in the Bloomberg Commodity Index, back then it was Dow Jones UBS Index. And the standard deviation of the index 07 versus 08 increased 2.4 times when the vol hit in 2008. The next thing that happens is that correlations increase. So commodities, which as Jason pointed out, are very uncorrelated to each other, there was an increase of 2.9 times in their correlation. So volatility increased, things became correlated that weren't correlated before. And here's, I think, the largest effect, and this is where managers can really step in and generate alpha for you, and that's in serial price correlation, autocorrelation within markets. Autocorrelation measured weekly price moves. Right? I used Wednesday to avoid any weekend effects. Wednesday, weekly price moves increased 5.8 times. Yeah, 5.8 times. 5.8 times. It was the largest effect, 07 versus 08, in commodity markets. So it's not only in 08 that this hit. You look at 1998, another crisis event. You look at 1987, the stock market crash. You see the same 3 things that happen. Volatility increases by definition. It's a crisis event, right? Things become correlated that were never correlated before, and that's what really hurts people's portfolios, because they design a portfolio based on past correlations, and in 08, past correlations fell apart and portfolios went down. 22, it's happened again, stocks and bonds. People design a portfolio, putting stocks and bonds together. When they both get down, when they both go down, you get hurt. That's why having something like commodities and having an active management style within commodities is effective. And especially when you look at trend following momentum, where autocorrelation increases, every single crisis event, autocorrelation increases, and you can make money with trend following momentum. It's just one of the styles that works, and works particularly well with commodities when that crisis event hits, and enables your portfolio to be very well diversified. I know we had a lot more to cover, but I think we should probably just open it to questions now, and we can probably continue to cover what we're, other things as the questions come.
We're now going to open the floor to shorter speeches. Discuss his questions.
Thank you. We talked about the concept of investing in commodities through non-physical means. But what's your opinion about holding actual, gold or silver or platinum? I'm not sure anyone would be holding bricks of copper, but still, what's your opinion about that? Thank you.
So physical is really something like gold and silver. They have this beautiful property of not having to dissipate over time, and because of that, storage for them is a little less hard, but still difficult. Because if you think about what it takes to sort of store gold in your backyard, right? You go in, you dig up a thing, you have a metal container, you put all the things in, and you bury it, right? Only you know it's there, and if you're the only person who knows it's there, it probably works out for you, right? It's not liquid because clearly it's buried in the back of your yard. It's not fungible because
it's buried in the back of your yard, but it is secure. The problem with having it elsewhere is that you have to pay a lot for security. And that's something that doesn't diminish over time. That's gold. Oil deteriorates with time. Corn deteriorates with time. Wheat deteriorates with time. Copper deteriorates with time because of oxidation. Like, you have all these things that are probable where you need proper storage, and you need to pay for that proper storage. You need to have a conscientious development around what it takes to sort of store that commodity to have the convenience yield to then pay for it. Futures, you don't have any of those problems. You don't have to take delivery. You don't have to provide delivery. You don't have to provide transit. You don't have to do any of that. You have this future, which is really nice, easy to deal with. And I yield my time.
I would just say one thing about
Copper,
yes, it's hard to store, but that's a particularly interesting commodity at this point. So there's a concept right now that is becoming widely known as AI electrification. I don't know if you've been following that whole theme, but it really relates to the idea that a lot of the renewables that go about underpinning the use of electricity more broadly, the sources of that electricity, particularly on the back of all the green initiatives that we've undertaken with respect to solar and wind, have required that a lot of this stuff get put together. So one of the interesting things that's been created is this notion of a synthetic power plant. And that's essentially wiring in a whole bunch of disparate solar panels and windmills and all of it, and then having essentially an intelligent way of capturing that, storing it, thinking about pricing mechanisms that can induce behavior on the behalf of these consumers so that they're consuming at the right time of the day. And all of this is necessitating significant increases in wiring using copper. And we've seen a significant increase in copper consumption, even within China as a result of these initiatives, even though they have a very moribund real estate situation that they're dealing with at the moment. Their use of copper is up year on year about 12%, simply because of all these other activity that they're engaging in. And I noticed that we're actually citing a lot of statistics. I'm going to quote Stephen Wright on this topic, that 78.2% of statistics are made up right on the spot.
I would answer your question by using Jason's analogy, putting the gold in the backyard. I wouldn't mind doing that if the risk premium was high enough that I want to own gold. But the problem that I see as a trader is that risk premium is going to change from time to time. So as long as I could swap that ownership of gold and switch with you, and we could just trade off, when I don't want it, you can have it, and you don't want it, I can have it, well, then I might as well just use a futures contract. Because then I have the opportunity to get in and out very quick and facile with my ownership of this, plus any other commodity that I might want to own, because its risk premium, I determine at this point in time is worth owning. And it might be worth shorting if I don't want to own it.
Yeah, last time I checked, the storage costs they charge you about 0.5% a year, maybe a little more, maybe a little less.
Or you could put it in the vault.
Yeah, you can put it in the vault. You've got to guard the vault.
So, a lot of interesting points. As an active manager for commodities, 3 parts to it. One is when you look at the overall picture, right? You have an allocation for equities versus bonds versus commodities at 15%. How do you really look at the correlation? I saw there was like a strong correlation. I mean, there was a little bit of but they're moving in tandem. So is it like, are we trying to really diversify, or are we trying to dampen the wall in the actual portfolio, right? The second part to my question is, you're looking at these as individual exposures, right? Commodity as a bucket. But when you really look at commodities, gold plays very differently on a risk-on scenario versus a risk-off scenario, right? And copper plays more when overall there's a growth in the economy and there's a lot of activity. So how do you bucket everything under like an actively managed portfolio? And then when you're doing that, when you look at the variation margin, like if you have forward versus futures position, you're just kind of taking a directional bet. What is the limit, or how do you think about it from an active management perspective? Lots of questions, sorry, but it's
Okay,
fascinating.
if you don't mind, I'll take a shot, but I'll be quick about it. So, one of the things that you can do is think about commodities writ large, or you can think about them as individual entities. And the reality is that for very long periods of time, the returns you're going to get from any specific commodity are going to be dominated by very short lives of supply-demand considerations. So if there's a frost, drought, if there are bad winds that dry out the trees that they produce cocoa pods in the Ivory Coast, these are very idiosyncratic exposures. So you're right that there's a difference between an index level exposure and some of the things that can go on with specific commodities. If you wanted to take a commodity that gives you the most insight about what's going to go on in the world with respect to more of a global macroeconomic picture, the energy markets, in particular the crude oil market, has the most stable anti-correlation with the price of bonds. So it plays a very central role. And that's kind of why Goldman skews that particular, their particular view on the commodity world. But as a professional investor, what you're really thinking about, in our case, we're taking a look at commodities as part of what we do and thinking about, okay, here's a broad-based index that characterizes commodity prices. Is it moving up at the moment, or is it moving down? And you can use econometric techniques. We use some kind of adapted version of a Hodrick-Prescott filter just to get a sense as to whether things are moving up or down. And then once we've made a decision about this is going up or it's going down, then we're going to take a look at only that subset of the commodity world, which is in significant relative backwardation if we're betting that the market is going up. And you get substantially better performance out of an overall trend if that's the way you do it. Similarly, if you're believing that commodity prices are moving down at the moment, you're restricting those things that you're shorting, only the stuff that's way overpriced and is in significant relative contango. So you're making a bunch of very specific decisions about it. And you're not just picking commodities, you're picking points along the term structure in order to maximize those sorts of effects. And so that's really how you would do it in a more, that's the strategy you don't do at home.
I think your question really provides support for active management. And the idea, from the active manager standpoint, is to really take positions in those commodities that are giving you the most risk premium, the most alpha opportunity, and take short positions in the ones that are opposite to that, and then blending that into your portfolio. And in terms of the rebalance, you want to rebalance as frequently as possible to take as much benefit as you can from the diversification effect. So as long as your trading costs, your transaction costs are not hurting your benefit, you want to rebalance as much as possible. So as an example, we rebalance our portfolio on a monthly basis. So that's between all the asset classes that we trade. So if we make gains in our commodities, we move that to our other contracts. If we make gains in other contracts, we move that to our commodities. And the point about diversification and they're not a heterogeneous set. People think commodities is an asset class. They are an asset class when you speak about them simply. But really what it is several asset classes. You have energy, you have grains, you have metals, and they do act all different.
And then to sort of put that, how does that work in terms of your general portfolio? Here's again where active management makes a lot of sense. So you have that selection process that they're going through, and they're saying, okay, these particular commodities play really well for this environment we're in. As the allocator, you are a step back from that problem. You don't have to worry about some of the trading process. You don't have to worry about some of those trading problems that happen. For instance, delivery or non-delivery. How am I going to play how I'm playing physical gold versus futures? How I'm doing other things. You're paying for that experience of the commodities, right? That in itself fits into your portfolio as that diversifier for against the other things you have at play. And again, because of the low correlation, because of some of these properties, you have alpha performance that comes to that portfolio that lowers your overall volatility of your book, even though commodities themselves have a volatility
similar to equities. It lowers your volatility because the performance happens at a different point in time, right? So you're lowering that volatility of your general portfolio and adding some buffer, because you have to smile, you have a concave smile in terms of that when things are profitable, right? The straddle, right? You have a straddle performance happening in your commodity world. So you want that to sort of to balance out some of this other stuff that you have going on. Some of these carrying things such as fixed income. Fixed income has these carry properties, which is problematic during times of stress. So you want this concave portfolio to perform to sort of balance out some of this carry that you have implicitly by your rest of your portfolio. And that is where commodities come in, give you that straddle performance. If things get too hairy each way, the active management of a commodity portfolio is going to give you that outperformance.
So the outperformance is over the alpha is your benchmark, which is your index, and your individual performance is how you measure your outperformance.
Sorry?
How do you measure your outperformance?
Outperformance is against the BCom. That's how I like to think about it. It's against whatever index that you're setting up. That's going to be your outperformance. But in terms of your general portfolio, you also have to think about the concavity of what the commodity strategy is going to give you, right? You need it to be concave because you have so much convexity in your general solution, in your general portfolio.
We've got time for just one more.
You've got a lot of really good information on the mechanics of how these CTAs or commodity trading advisors or these commodity trades work. But I have an idea, and I want you guys to each expound on this, and then we can go have a break and get something to drink. But right now, I attended a conference the other day, and they had a gentleman from Anthropic and a cloud provider talk about this coming revolution, which I haven't heard yet, called AI. Now, maybe we've heard it all too much. But what one of the guys said, the guy from Anthropic said that this is going to be a $100 trillion market within the next 10 years, which exceeds the global economy. And the cloud guy says he's getting calls for data centers requiring 500 megawatts of energy, which exceeds by far the current availability of electricity. So my question to all you guys is, if I want to play that, if I believe that AI is going to be a growth opportunity in the future, obviously somebody's going to have to power all of this. Is there a sort of like an AI commodity fund that will probably make somebody a lot of money in their portfolio?
So
We kind of talked about that a little bit earlier on, which is this, what's going to be required in the context of applying AI to the renewables, which is through the use of copper. There are other metals that are out there that are important. Nickel's very important in the context of nickel hydride batteries. Lithium's very important. Lithium-ion batteries. Cobalt is kind of important. They use it for making anodes. So there's a lot of plays in the commodity world that are actually related to the AI world. There is sort of an interesting feature that I don't think we fully comprehend, which is this thing that you were pointing at, which is our current demands for electricity are effectively outstripping the technology we have for controlling it, signaling, and storing it. Just as a for instance, 70% of the scale utility storage of electricity right now is done using a very primitive form of battery. And that battery is, during the day when it's sunny and perhaps when the wind's blowing, they pump water up a hill to a retaining basin, and as they need the electricity, they let it roll back down and drive a generator. That's literally 70% of our storage of this sort of stuff. So there's some wacky stuff going on, and there are a lot of problems that have not been resolved. There are a lot of stressors in the system still. But I would think the play in the commodity markets is that subset of, if you wanted to hold them on. But I think there are really things that are more interesting to do in the commodity space, much more interesting. And one of the things that, our whole purpose for being, in terms of the way we're thinking about it, is there are a lot of players who are big players that participate in these commodity markets, but really too big to be there. So, my home country, Canada, all of the wheat production is done by all of these farmers, and they give it to the Canadian Wheat Marketing Board, and then they'll go out and hedge Right? Canada's a big place. It's bigger than the United States. They produce a lot of wheat, and it creates all of these distortions in the term structure of these markets. And what we do is effectively just constantly scan the market and look for rich, cheap, trades one commodity against another, structure a long book or a short book, capture, roll yield in the markets, and do it in a way that we stay small, that we remain a niche participant in the market, because I don't want to be the signal. I want to be the predator, not the prey. And, so I don't even know that what we do is particularly interesting to a lot of people, because it's never going to be more than about 300 to 500 million in this fund at a max, and then money has to be given back. Because where you can really take advantage of these markets is being nimble, it's not having high transaction costs, it's not being a huge part of the average daily volume in the trading of these things, and taking advantage of all of the much larger participants, the BlackRocks, the Goldmans. I'll give you one example. When Goldman first came out with their commodity index, they published their roll dates. Now they publish a span, and all the locals would line up to take advantage of them. And it was a thing where you knew the date. It was called date rate, because all the locals would, so, in any event, there's a lot of that goes on in the markets. I heard Rick Santelli talking a little while back. It was a Sunday afternoon, a Friday afternoon, and they asked him what was going on in the markets. It was the summer. And he said, there's nothing going on. It's just the locals stealing from each other. Which I thought was kind of an interesting insight. But in any event, there are things you can do if you really keep in mind that model that we're talking about, that indicates richness, cheapness, and how to structure bets and do it as a professional. And there's so much you can do to take advantage of this. So,
just a short item to add. When you speak about something at that scale, regulation is definitely going to come into play. I mean, you've already seen it with bit mining, with Bitcoin, where certain municipalities have just said, okay, we're going to cut it at this point. Other municipalities have actually gone the other way, say, let's bring all the Bitcoin farms here. We'll take them. We want to add to our economy. But at the scale that you're talking about, regulations are going to have to come into play, because it's going to be competing with other people's need for energy. And in the commodity space, it's a huge factor in commodity pricing. We were talking about cocoa, and we showed the cocoa chart a moment ago. Cocoa is one of the commodities that the EU Deforestation Initiative is treating. So by the end of this year, cocoa coming from cocoa farms in West Africa have to be GPS labeled as to where they came from, and shown that they're not coming from a location that has been deforested. And the transit supply time from West Africa to Europe is more than 1 year in terms of the supply chain. So cocoa that's being shipped now that's not labeled, the EU hasn't figured out what are we going to do with it. Can we actually accept it into the market? Can we sell it? So it's a question. It's not going to be extended. It's not going to be extended. But regulation is one of those things that really affects commodity prices as well.
And I want to touch on this because this is super important on this subject. So what you're talking about in terms of AI fund, particularly, like there's something called like a levered cost of energy, and there's also a levered cost of heat. And it's basically this idea of like what AI is going to use to consume, like to generate this electricity, right? Part of that is metals. Part of that is the metal index, like base metals, coppers, which Andy talked about earlier today. Part of that is your nickels. Part of that is a lot of the industrial base. They have to compete with the other alternative use. And at some point, regulators are going to step in and they're going to say, hey, no, you can't use these things for this particular purpose. I don't care what you're doing. There are some basic needs that humans need to fulfill. I don't care how much this is supposed to generate in the future. I don't care what this is supposed to do for down the road. Currently today, people need this for X. We are going to allocate for X. And if you have any other problems, please see our art. Right? In terms of energy and in terms of metal consumption, like AI is really consumptive. Really, really consumptive. And so at some point, even though there might not be enough energy to like actually fulfill some of those AI models down the road, we're going to hit a point where people will be like, that's okay. and we're just gonna have to live with what we have until someone figures out the future.
Yeah, right now, I just moved to Boston from Colorado, where they had, a lot of people would drive Teslas and drink cortados. And the idea is that if I own this electric vehicle, that I'm doing my part for society. Turns out 60% of the electricity in Colorado is from coal mines in the neighboring state, Montana. And they are literally coalmobiles, the dirtiest cars on the street. So, I mean, there are a lot of interesting unintended consequences.
I'm sure we can keep talking. This has been an amazing discussion, so thank you all for being here. Big thank you to our panelists. Thank you to everyone for being here tonight and listening to the panel. And thank you to our sponsors once again. We do have, if you take a look at the screen for any guests who are here tonight, there's a little barcode that you can scan and sign up to become a member. So please do become a member if you're interested in joining the roundtable. We host every month. There is the next event, the announcement for next event. We are hosting on May 16 with BlackRock leading the panel and potentially Rockefeller Capital Management to confirm, among others. So that's a good panel. That's May 16, and June 25 is the June event after that. So please be on the lookout for future event invitations, and we look forward to seeing you all. Stick back, enjoy some drinks and food, and see you around. Thank you.